Hello and welcome to this latest edition of Courses on Demand brought to you by Forex.Academy. So in this course, we'll be looking to discuss solid charting in some detail. Just before we begin, there is of course inherent risks involved in trading the financial markets. So please do take a brief moment to familiarize yourself with the following disclaimer. If you do need to stop this recording, you're very welcome to do so. Do please take note of the details currently up on screen. Okay, so let's discuss exactly what you can expect over the course of this webinar. We'll start by defining technical analysis. Then we'll have a look at the role that technical indicators can play when it comes to those that analyze the markets from a technical perspective. Then we'll have a look at specifically price action. We'll define it for you in some detail. We'll discuss the importance of charting. And we shall finish this webinar by looking at seasonal charting and explain to you exactly what that is. Okay, so let's start with a definition of technical analysis. So technical analysis is an analysis methodology for forecasting the direction of prices through the study of past market data, primarily price and volume. And it's the study of past market data which is all important. So what we see when we look at a price chart is along the x-axis, you will be able to identify a time frame along the x-axis here down the bottom. So as you can see, the price just within this area is the time frame. But on the y-axis, what you will see and experience is the change of price over that particular time. And that is what is of real value to those that trade the markets from a technical perspective. Because if they look at the movement of price, whether markets move to the upside or to the downside, they can analyze this market appropriately depending on the volume of these moves. And if you can identify areas in the market which is experiencing considerable volume, either to the upside or to the downside, then that can give certainly technical traders a bit of an advantage if they can understand what has happened to price market data, and they can understand that movement of price with volume. Then they can give themselves an edge in terms of looking to identify and understand exactly what's happening. So from this chart, broadly speaking, within this particular time frame, we can see that this market starts from the bottom left-hand corner, roughly at a lower price, let's say, to the current price, which is top left. So if we just draw a line, what we can say over the course of this period of time is that prices have been moving to the upside. I hope you would agree with that. Now, we're seeing periods of consolidation in there, especially more recently. We can certainly use our understanding of technical analysis, our understanding of price movements and price action to actually understand that we're actually currently in a prolonged period of consolidation over a significant period of time. And this is what this is that understanding of past market data, and that's why it is of such importance to traders. So that's just a brief sort of overview about technical analysis. It's understanding what's happened previously, and that being enabling you to be informed and make very, very informed decisions about perhaps your trading approach and how you can capitalize on these market moves. So to explain it in a little bit more detail, of course, traders are very much aware that there is a vast number of technical indicators or tools which can certainly be used to study past market data. So all of these price developments, traders can identify a whole variety of different tools that can effectively give that trader a particular edge or a little bit more confidence in perhaps some of the trades that they would like to be involved with. So we're just going to run through a few of these, and a lot of these indicators are used. They're very, very popular indicators, and they're used to varying degrees accordingly. And we just want to go through and explain a few of these indicators and how they help with technical analysis. So we'll start off with a very common indicator, which is your moving average. This happens to just have two what are called simple moving averages on a chart. And the idea behind that, this particular indicator, is that you can certainly, to begin with, just very visually see what direction markets move in. So you could identify that these markets have very much been in an uptrend between these 2 points. Let's call this point A, and you can very much see that from this period of time as well, this market has been in a period of consolidation. So that is allowing traders, technical traders, to use this particular indicator to identify what is currently happening based on past market information and price action. So that is the I suppose the basis really of a very commonly used indicator. Now, of course, there's pros and cons with all of these indicators, but to just go through a few more, and what we'll do is we'll add these over the top. What we see now is our Bollinger Bands, and these are used by technical traders, maybe as opportunities to buy off the lower band, expecting prices to move higher, and selling off the higher bands. Now, again, you would need to understand completely how to interact and how to utilize this particular indicator to its fullest. But we just want to just ever so briefly just discuss with you all of these different types of technical indicators that can be used to effectively allow technical analysts to be able to study past market data. So another very popular indicator could be your average true range, and this is not so much impacting the actual price action, but we can get the readings from a little chart below the chart in terms of how volatile this particular market is, and it gives you what's called an average true range over a certain period of time, and that could be very useful again. And we're looking to study past market data. Another very commonly used indicator is your fib levels. So these types of traders, again, they're looking at past data, so they're capturing swing lows to swing highs, and they're seeing if they can identify opportunities where this market can pull back to, and seeing if an opportunity presents itself for these markets to push higher off these particular levels, predetermined levels. Now, again, each of these indicators needs to be used in a very specific way. So a considerable amount of understanding about a lot of these indicators, and we do cover these in a lot of our other courses on demand. But it just gives you a very, very brief and basic overview in terms of how, again, traders can utilize these indicators to be able to study what's gone on in the past, and that can really inform them in the decisions they're about to make about price action. Now, just the last indicator, which is again a very commonly used one, is our stochastic indicator here along the bottom, just below the ATR. And in simple terms, what this means is it can give traders an idea in terms of a measurement of a market being in a period of being overbought or undersold. And if a market is overbought, it might present opportunities for sellers to sell at these levels or at these correlated prices. You might get opportunities to sell at those specific levels, and these all correlate with these peaks up here as well, to varying degrees. However, it might give opportunity for buyers to be entering the markets at these particular lows, which then coincide with some of these lows that you can currently see on the charts. So all of these indicators have pros and cons. They can be used in a whole variety of different ways, with actually individual different interactions, way in which traders can interact with each of these indicators can vary slightly as well. So that must be taken on board. However, nonetheless, all of these indicators can effectively do the same thing. They can certainly allow to give you some significant confidence behind some of your trading decisions. So hopefully that just briefly outlines and there is a vast number of these technical indicators. I've only shown you, a small sample, and there is many, many more. So following on from this, let's have a look at the role of technical indicators now. And pure and simply, they're a statistical measurement of price variance. So really, we're looking to see how price varies over a particular period of time. And we can use these technical indicators to be able to measure these price variances. And again, all that will do is inform the trader and assist them with being able to perhaps identify a particular edge in the market and give that trader some opportunities that they can look to capitalize upon. They can also help traders with objectivity when trading, it's a very, very important skill to develop. Is the potential to be objective. And obviously utilizing some of these indicators can allow you to become very objective in your decision-making process, which is ultimately a very, very positive thing. And that can really help. And again, it's about being informed. It's about actually being able to rely on a particular methodology and having tools that can assist with that level of confidence. And it can enable you hopefully to be in the market long enough to gain and get the experience you need to become a consistently profitable trader. Also, traders often prefer different indicators for very, very different personal reasons. So they just might prefer and feel more comfortable with certain indicators over other ones. Now, they can all perform a particular sort of role, perhaps within your trading methodology, but they all have pros and cons. They all have good points and some negative points. But it is important to recognize that there is a cherry picking approach, basically, by a lot of traders that utilize technical indicators in terms of which indicators make more sense to them and which ones they're comfortable adopting. Technical indicators can be supportive of underlying direction of bias, so they can certainly assist with a more natural approach to assessing markets. They can certainly give a trader a little bit more confidence in the decision-making processes. And they can also assist with traders with their specific entries and exits. So when we looked at the Bollinger Bands, for example, and we see price moving to the lower band, it might present opportunities for traders that use Bollinger Bands to look to buy the markets at those levels. So of course, it can therefore help with entries in that situation. And also, if that market decides to move to the upper band, they might decide to use that information as a source of exiting that market as well. And finally, the role of technical indicators can assist traders with very, very little experience. However, it must be understood that only obviously if those indicators are used correctly. And what often is the case for those that are new and inexperienced to trade in these financial markets is, for one reason or another, they might adopt a particular indicator and not particularly use it in the correct way or in the way in which it was supposed to be used. So of course that can lead to certain difficulties. However, for the large, they can assist traders that have little experience, that can give them an edge, allow them to enter and exit markets, hopefully with a degree of objectivity and be able to adopt a very consistent approach to these markets. Okay, so leading on from a look at technical analysis and also technical indicators, we also have price action. Now, price action is a form of technical analysis. However, it enables traders to make decisions based on pure price movements are what's called naked price charts. So that's actually stripping away a lot of the indicators. A lot of traders who use a number of indicators, their charts can look very messy. It's very difficult to actually see what's currently happening to price. Whereas, those that study price action specifically, and the aim of price action is to be able to identify patterns of dynamic support and resistance levels and things like reversals and trends. So again, this is a variation of those that use technical indicators to technically analyze the markets. There is also those that prefer to use price action to analyze and understand what's going on. And of course, then there's the variances of both types, those that use indicators and a very clear understanding of price action as well. So to become a competent trader of price action, it will be necessary to develop your knowledge and understanding of these two key commonly used components of price action. And the first one is an understanding of Japanese candlesticks. So we've produced in other courses on demand, we have produced a course on Japanese candlesticks, which you can access in due course if you've not already done so. But the basic principle is knowing and understanding what is happening to price. It's knowing the highs, the lows of the markets, the open, the close of any particular time period, and knowing whether these markets are bullish and move, whether price is moving to the upside, or of course bearish, which means prices are moving to the downside. So a very clearly defined understanding of Japanese candlesticks, and these are just the two most commonly used components. There is other forms of being able to analyze price action. However, Japanese candlesticks is by far the most commonly used. And in addition to Japanese candlesticks, we also have Japanese candlestick charting patterns as well. And excuse me, just like I've alluded to in the previous chart, we can utilize our understanding of Japanese candlesticks, and if we bunch our understanding of Japanese candlesticks together, we can start to identify formations building in these markets, and we can see that this particular market is moving to the upside. We get a bounce off at a particular high price point. We create a low. We try to make a new high, which actually fails in this particular example, and then the market starts to move on its merry way to the downside. So from a charting pattern perspective, this is a very, very bearish formation of price action, because it's referred to as a double top for those that understand price action. So it absolutely can give opportunities for sellers to maybe sell at these levels, this double top level, and if they miss that, then they might get opportunities to sell when we get a break of this previous low. So those are the two major components that those that prefer to practice price action, where they're looking at very, very naked charts. As you can see on this particular chart, it's not cluttered with lots of different indicators. It's quite clean cut, where you can actually clearly see price action. You can see how the market reacts around those levels, and it's that information, looking at past historical information, that can give these opportunities to those that trade the markets with an understanding of price action based on their knowledge of Japanese candlesticks and also charting patterns. And you can see within this chart as well that there's a myriad of different sized candles, different sized wicks to the upside and also wicks to the downside, and the size of the bodies as well can vary drastically, and they all mean slightly different things. So your basic understanding of Japanese candlesticks on a singular fashion is very, very useful, but most importantly, in terms of a pattern, a combination of different Japanese candlesticks will be very, very useful for you if you prefer to choose a form of technical analysis which is based on price action and what price is actually doing. Okay, so to just kind of give you a bit of an overview from a charting perspective, we can have a look at price action, and we can see, I suppose, the reason why those that trade price action, they can again look at past market data. They can identify significant opportunities in markets, which is based on volume, price movements and volume in these markets. And these are your larger candlesticks, both to the upside and to the downside. And that's what traders are trying to capture. They're trying to capture that volume or that volume-based movement in advance of of that particular breakout. Now, there's certain things that those that trade the markets from a price action perspective can identify. Again, they can monitor highs and lows. They could look for opportunities to sell these markets based on their understanding. They can see a bit of exhaustion at these double bottom levels. And I'm just going to go through a few. They could identify a bit of what's called a structural failure to see if they capture a little trade to push higher. They might identify this high, which coincides. You might get an opportunity maybe on an intraday basis in this example to push higher. And these trades are very, very easy in hindsight. But again, there's structural failures to the downside, which I can just go through these, and you can see the sort of the basic. I mean, not all of these have to be winning trades by any stretch, and it does depend on your approach with regards to entry and exit and your approach to risk management. But the basic premise of this is that those that can identify what's going on with both Japanese candlesticks and the combination of Japanese candlesticks are able to navigate in and out of the markets in a very, very coherent way. So we could monitor this particular high up here, excuse me, see the pullback, which might either give the opportunities for those that trade price action to capitalize on this significant price move very, very early on in that process. So this would be more of a pullback trade. We have structural failures, we have breakouts. So of course there is a myriad of ways in which we could trade these markets, and just identifying a little bit of price action. We did mention also that it is about an understanding of support and resistance. So we could look at this historical price action and suggest that the market can be sold from these highs on multiple occasions to the downside. And of course, they can also be bought from this lower band of price action. And as you can see in this example, you could have multiple opportunities to both buy and sell this market. And on each of these occasions, because what we are trading is what's called a descending triangle from a price action perspective. And in each of these particular trades, it would have constituted a significant a number of profitable trades based on a very, very basic understanding of resistance, preventing prices from pushing higher, and support, which prevents prices from pushing lower. So this is a basic understanding of price action, reversals, and trends and opportunities to capture these markets based on your understanding of Japanese candlesticks and also charting patterns. So I appreciate it looks particularly messy up on screen, but this is the general overview of an approach from a technical trader who is looking to implement their understanding of price action. Okay, so moving on then, we'll have another look at the importance of charting. We just want to raise a number of points. So we can see our chart here. This happens to be the gold market, and we can see what's happened to price within this range and this time period. So generally, we've been in a more of a recent uptrend. Prices start in this particular chart roughly bottom left, and we're currently up at top right, except there's obviously a lot going on with this chart. So why is charting so important? For a number of reasons. It offers traders an accurate representation of price and what is truly happening to price. And that can't be taken lightly, because that is what can give traders a very, very specific edge when trading these markets. And the fact that it's accurate is quite useful. We have a way of measuring exactly what these price points are. For those people that use MetaTrader 4, you can use your data window to do that, and you hover over any of these particular candlesticks, and it will give you the high price, the low price, the open price, and the close price of each individual market. Again, very, very important skill for those that use charting as a form of technical analysis. So also, every piece of information about each market is contained in its price, and that is really, really important. There is other forms of analysis, of course. It's not just technical analysis. We have those that make decisions based on fundamental developments, and we also have those traders out there that make trading decisions on the back of sentiment. And the problem is with fundamentals is it's very difficult for a retail trader to be able to acquire all of the information that they need to make all of the correct trading decisions, just because there's bigger institutions out there with access to more data in a quicker time frame, and that can disadvantage a retail trader when trading these markets. However, when we're talking about price, every piece of information about each market is contained in that price. And what we mean by that is if there's a particular fundamental news that is very positive for a particular economy, for example, and that has a positive impact on that economy's currency, then when we look at that currency, what we will see by looking at a chart or a price chart is we will be able to visually and accurately see that price move to the upside. And it's then down to your ability to technically analyze these markets and with your approach to risk management, of course, it will enable you to navigate that particular bit of price action. So it's just a very, very good way. And what it does is it links hand in hand with the next point, which is that it creates more of a level playing field than sentiment and fundamental analysis. And that's really quite important, because you can trade what you see. You can see the actual price. You can ignore sentiment and fundamentals to a certain degree if you just purely focus on what price is doing and make decisions on that basis. Then you are operating in a slightly more level playing field. Now, you're never going to be on the same level playing field as those institutions out there that have incredible amounts of capital to be able to move markets. But from a retail perspective, at least you can see the same price moves to a certain degree as everyone else. So it's just worth noting. And finally there, the price of a market is a standalone, very important component to study in its own right. So it's really looking to capitalize on past market data, understanding price movement and volume within a market, and you'll be able to make some consistent decisions when it comes to trading these markets off the back of that information. Okay, so the last topic that we're just going to look at is for those traders that look to trade seasonality or they use charting for seasonal purposes. So let me just start by giving you a definition of seasonality. This is the tendency for certain markets to perform potentially better during certain times of the year, and of course worse during other times of the year. And a good example of this would be with regards to a lot of, well, the commodity markets potentially in general, and some other markets outside of commodities. But a good example would be your soft commodities like wheat. Due to seasonal increases of supply due to the harvest season itself. So obviously with a lot of crops like wheat or corn, then they're obviously harvest at certain points of the year, and decisions can be made as well, and charts can be used for that purpose. So seasonal charting now is simply the use of technical charting to help identify and execute seasonal related trades. So it's just having an understanding that the thing is with a lot of commodities, they're very much based on supply and demand. So there is some key points to consider when seasonal charting a soft commodity like wheat. So let's take wheat, for example. And the first point would be to have a basic understanding of the harvest times as well for each of these commodities. And of course, if a particular commodity like wheat is harvested, there'll obviously be yield related expectations on each of these crops. So there'll be a certain expectation, and that expectation will be built on things like the amount that will be produced, and a lot of aspects of some of the conditions in which can impact that yield expectations. Obviously, weather being one of those, being a huge factor in the potential harvesting of a whole range of soft commodities. That yield expectation is what would be scrutinized and will be actually covered in the crop reports. Now, the US Department of Agriculture produced reports on the harvesting of many commodities. So you're very welcome to look at USDA and crop reports, and it gives you some fantastic information about all the crops you could imagine. And that's where a lot of these yield expectations and harvesting numbers and things like that will be produced. And off the back of that obviously therefore has an impact on supply of that particular crop. And obviously an undersupply can lend itself to certain responses from a price perspective, and of course so does oversupply. So if there's an undersupply and there's more demand for that product, the price is likely to go higher. If there is an oversupply, which there's too much of the crop being harvested, it's readily available, it can become much cheaper. So we're talking about fundamentals of supply and demand. And of course, therefore, that has an impact on the actual price itself. So to try and explain this in a little bit more detail, we've got this chart up on screen, and this happens to be a wheat chart over a monthly period. So we have all of the considerations that we're looking at in terms of harvesting and yield expectations, and of course the production of these crop reports, which gives the markets and not just markets but the future markets, and also farmers and those that are involved in agriculture. It gives them a bit of an overview. The impact that could have on supply might go up, might go down, and therefore that has a direct impact on the potential price of that particular crop as well. So the one thing I'd like to draw your attention to is we've highlighted the month of January each year over the last 6 years. So you can see the January highlighted on your screen over the last 6 years. And please notice the prices at January of each yearly cycle in relation to the high prices of that same period. So it's not so much about the actual price itself in the month of January. It's actually what has happened prior to that price. So what I want to draw your attention to is the high of this yearly cycle, and draw your attention to that the following January is actually at a lower price than the high of that annual cycle. And you'll see this pattern in this particular market repeat itself on many times. So the high of this period, which if we take supply and demand into account and the way that that can impact price, we can see that again, the price that we're experiencing the following January is at a lower price. And as you can see, in each year, that same pattern exists. So what we're simply saying is that prices move from a high price to a low price, and that low price is normally in and around January in this particular example. Now, all of these markets are subject to change depending on potentially any one of these particular considerations when it comes to charting and observing. So those that trade these conditions, they can use charting patterns to monitor the highs, look for opportunities, maybe as a strategy to buy the January low price, knowing that we're likely to get a little push higher. So if we look through each of these prices, the opportunities may vary. There might be opportunities to sell at particular high prices, expecting over a period of time for prices to actually move lower. And you can see that the highs of these markets are coming roughly at the same time. Now, this doesn't happen to happen each year in, year out. But if those that analyze these charts from a seasonal charting perspective can identify when these prices are pushing higher, and they have an understanding of potential harvest and yield expectations, and they analyze crop reports, and they understand the impact that that can have on the potential under or oversupply of a particular commodity, they'll have an understanding of the impact that that might have on price and look for opportunities to either sell these higher prices with the potential to maybe even buy the lower prices. So just to give you a bit of a kind of a practical example of seasonal charting and how charting can be used by those that are wanting to take a seasonal approach to certain markets. This is only one particular example. We're talking about wheat at this point. So you can absolutely interpret the price action of certain charts based on identifying patterns like you can see up on screen. Okay, so that just about concludes this particular webinar. So to just review basically what we've covered. We've defined technical analysis. We've looked at the role of technical indicators. We've looked at price action, which is a form of technical analysis. We looked at the importance of charting, why it is so important to so many traders. And then we just finished on seasonal charting. So, so all that's left for me to do is to obviously thank you very much for joining us for this particular course on demand. And we look forward to seeing you next time. Take care. Bye for now.